Welcome to This Explainer. Look, today I'm putting on my financial advisor hat because we've got to talk about an incredibly urgent macroeconomic shift. Seriously, between the rapid disruption of artificial intelligence and the hidden, corrosive effects of global inflation, protecting your wealth over the next decade is going to require a fundamental rethink. The old rules, they simply do not apply anymore.
Okay, let's dive into this. Arthur Hayes, the former CEO of BitMEX, recently hit the nail on the head. He pointed out that a 10 to 20% wave of job losses in knowledge work due to AI isn't just an employment crisis. It is literally game over for the banking system. Why? Because of the sheer amount of leverage in the system. Think about that for a second. AI disruption directly threatens the regional banks holding everyday consumer and business loans. It acts as a burning platform for our entire fiat financial system. When those banks take a hit, credit freezes up, emergency bailout programs follow, and when those money printers turn back on, well, your purchasing power is entirely on the line.
Now, to really grasp the stakes of this shift, we need to zoom out and look at the sheer scale of the board we're playing on. Right now, there is roughly $900 trillion of global wealth out there. 900 trillion. It's a massive number. And a huge chunk of that wealth is currently sitting in slow, analog, traditional assets, desperately seeking a safe haven from the exact AI disruptions and macro chaos we just talked about.
I know navigating a $900 trillion market shift sounds a bit daunting, but don't worry, we are going to break it all down step by step. First, we'll map out the Great Wealth Shift, then uncover the Fiat Currency Trap. After that, we'll explore perfect digital capital, analyze the Arbitrage Playbook of the smart money, and finally, look at the institutional tipping point.
All right, Section 1, the Great Wealth Shift. Where exactly is all this wealth going? Well, we're living in an analog economy that is rapidly being forced to digitize. And this brilliantly illustrates the current setup. Out of that 900 trillion total, a staggering $300 trillion is locked up in the global bond market. Meanwhile, Bitcoin represents just around $2 trillion. So why does this matter to your portfolio? Because it reveals a massive osmotic pressure. If even just 1%, literally 1% of that bloated analog bond market rotates into a strictly scarce asset like Bitcoin, it creates an enormous supply shock. Capital is always hunting for greener pastures. And folks, the rotation has already begun.
Which brings us right to Section 2, the Fiat Currency Trap. Let's talk about why traditional safe havens are actually destroying your real wealth right under your nose.
Michael Saylor outlines what he calls the first law of money. It goes like this: an asset's lifespan equals its value divided by its annual maintenance cost. Think about your traditional analog assets for a second. Real estate. You've got property taxes, constant maintenance, and physical risks. Gold. Heavy storage and security costs. And fiat currency? It is just constantly diluted by inflation. Basically, Saylor argues that these analog assets suffer from negative working capital. You literally have to keep injecting more money and energy into them just to maintain the value you started with.
So let's apply this directly to your portfolio right now. Look at the negative yield reality of the bond market. Sure, the 10-year U.S. Treasury yield might be hovering around 4.2%. Sounds okay, right? But if you look at real grocery store level inflation, the M2 money supply expansion, it's realistically running closer to 8 to 10%. The result is a negative 4 to 6% real annual return. So I have to ask you, is earning 4% while inflation eats 8% truly preserving your wealth? Or is it quite literally setting your money on fire in slow motion?
Okay, moving to Section 3, perfect digital capital, the search for absolute scarcity in an era of endless fiat printing. Let's directly contrast these two systems. On one side, we have fiat currency and bonds. They have an infinite supply, they're controlled by centralized authorities, they guarantee negative real yields, and they're restricted by local borders. Now on the other side, you have Bitcoin. It has a mathematically enforced hard cap of exactly 21 million coins. It's completely decentralized, it boasts a massive historical compound annual growth rate, and it operates globally without permission. As Saylor points out, if AI makes traditional business modes temporary, capital is naturally going to rotate to assets with mathematically enforced scarcity, meaning Bitcoin is completely impervious to AI disruption. And hey, it's not just better than fiat paper, it's a massive upgrade over physical gold too. Jack Mallers makes a brilliant point here. He notes that gold requires human legs and slow, expensive logistics to move around. It has no built-in network. Bitcoin, on the other hand, moves value globally in real time, basically for free. Think about it. If you need to send $100 million across the world, gold takes weeks in armed guards. Bitcoin? It does it in seconds over the internet. It is, hands down, the superior digital capital for the modern age.
All right, Section 4, the Arbitrage Playbook. Let's look at how the smart money is actually positioning themselves for this shift.
We're going to look at the genius financial engineering currently being pioneered by MicroStrategy. They are executing what Saylor calls a perpetual strife loop against the fiat system. Here's the playbook. First, they issue cheap, dilutive fiat debt or preferred stock to the market. Second, they capitalize on the premium that the market eagerly pays for that yield. Third, they take that cash and buy absolute, scarce Bitcoin. And fourth, they just hold it, as the digital capital appreciates way faster than the cost of their debt. They are essentially borrowing toxic, melting fiat capital at a super low real cost to acquire pristine, appreciating digital capital. It's a brilliant move.
So the crucial point here is how eagerly the broader market is eating this up. MicroStrategy introduced STRC, a digital credit preferred stock. Unlike traditional private credit, which, let's be honest, is usually illiquid, opaque, and loaded with high fees, this STRC instrument is highly liquid, totally transparent, has zero fees, and offers a massive 11.5% dividend. By offering the superior digital credit layer backed by Bitcoin, this instrument exploded to an $8.5 billion valuation in just 8 months. They've literally built a pump to pipe capital straight out of the analog bond market and directly into Bitcoin.
Which brings us to our final section, Section 5, the institutional tipping point.
You see, it's not just rogue corporations executing this playbook anymore. Wall Street is fully on board with the ETFs, but now we're actually seeing geopolitical validation as central banks finally wake up. Take the Czech National Bank, under Governor Mikl. Back in 2022, they faced inflation hitting a staggering 20%. They successfully fought it with hawkish policies, expanding their traditional gold reserves to 6% by 2024. But here's the kicker. Now, in 2025, they're launching a formal test of a 1% Bitcoin allocation as a low-correlation digital reserve asset. They'll run this test until 2027 to make a formal adoption decision. Listen, when conservative, inflation-fighting central banks start testing Bitcoin alongside their gold, the macroeconomic paradigm has officially shifted. No way around it.
Now, what's really interesting about this slide is what happens when we project this forward. Global asset values are expected to multiply by 2045 simply based on the required expansion of the M2 money supply. If fiat currency inherently expands by roughly 4.4 times over this time frame, any asset growing slower than that is literally losing real purchasing power. Bonds are projected to only grow 2.8 times. They're just treading water. Equities will do well, probably around 7.4 times. But Bitcoin, it's projected to multiply by 140 times. It is aggressively siphoning the monetary premium right out of these dying analog systems.
And that brings us to this absolutely staggering number, $10 million. That is Michael Saylor's base case vision for the price of a single Bitcoin by the year 2045. As it siphons capital away from that $300 trillion bond market and scales to a $200 trillion global network, he argues it won't just be some digital asset you buy and hold. It's going to be the core, pristine collateral backing an entirely new, friction-free digital credit system.
So, that leaves us with one final, absolutely vital question for you as an investor. If the absolute smartest money in the room, from massive public corporations to hawkish central banks, is systematically abandoning melting fiat for pristine digital capital, how exactly is your portfolio positioned for the next decade? Are you stubbornly holding on to the burning platform, or have you recognized the shift and found your safe haven? Think carefully on that one. Thanks for joining me for this explainer, and I will see you next time.